Okay, do you get it?
So hi, good evening, President Daly. On behalf of LSE Central Banking Society and Economic Society, I'd like to extend a warm welcome to both President Daly and the audience members for joining us today. Before diving into questions, I'd just like to give a brief introduction to President Daly. So President Daly is the 13th President and CEO of the Federal Reserve Bank of San Francisco. As a participant of the Federal Open Markets Committee, she is a key figure in setting the direction of US monetary policy. President's daily research has focused largely on labor market dynamics, as well as the aggregate and distributional impacts of monetary and fiscal policy. She has published work on economic inequality, wage and unemployment dynamics, as well as disability and retirement policies. So I'm your moderator, Jane, and how this session is going to be structured is that firstly, we're going to be doing a 30-minute moderated Q&A. So these are the questions that we have prepared beforehand as part of the Central Bank Society. And secondly, we're then going to do a 15-minute audience Q&A session afterwards, whereby the audience can send questions throughout this session into our Zoom chat, and we'll begin selecting those questions and letting President Daly answer them as a way to conclude this session. So with that being said, I think that I'll dive straight into the moderated Q&A session now. So President Daly, thank you once again for joining us. Just to start off, can you give us a brief overview of what your day-to-day work is like as both the President and CEO of the Bank of San Francisco?
Absolutely. And let me begin by saying thank you so much for having me. And I'm delighted to be with you all virtually. Hopefully next time it'll be in person. So my job is the best job I've ever had. I love being president and CEO of the Federal Reserve Bank of San Francisco and making a contribution to monetary policy, but also to the bank and to leadership. And my day really reflects all of those aspects. So I'll start with which top of mind, I think, for so many of us today is the news of Ukraine and what's happening there, and the devastation and the loss and the challenges that the Ukrainians face. But it also affects markets, and it affects people's questions about monetary policy and the economies. And so a lot of my time over the weekend and things was spent on thinking about those issues, but also thinking about the many employees I have who come from that part of the world. Either they're Ukrainian or they're Russian, or they have roots in those areas. So that really is what the job is always about. It's about making monetary policy, thinking about those goals, but also recognizing that we're leading an organization and that people work here. And you might notice, or it's hard to see, I'm wearing a blue lanyard today. And the reason I'm wearing this lanyard is because that's another important part of my job. Today, we opened our bank in San Francisco and all our branches for the first time in 2 years since the pandemic began. And we're welcoming people back and bringing them back into the office. We finally can relinquish our masks and fully go back to work. And a blue lanyard means that I'm comfortable being around people, and people can choose an orange lanyard. And that means that they would rather keep a bit of a distance because they're getting more used to coming back to the world without masks and social distancing. So those are important decisions I have to make about how do we lead, how do we move people through a pandemic, but then also how do we handle the news of the day and craft monetary policy. And you can see why it's my favorite job I've ever had.
Okay, thank you so much for that insight. So you did mention the pandemic quite a bit during your previous answer. So I just wanted to ask you that, over the past 2 years, the COVID pandemic has generated a lot of interest in the role of central banks in promoting economic recovery and also maintaining price stability. So in your opinion, has the Federal Reserve been effective in achieving these goals? And perhaps what lessons can we learn from this crisis moving forward?
Sure, and thank you. That's a terrific question. So let me talk about the Federal Reserve, not broader central banks, but I think you could characterize most central banks in the world as similar, and most fiscal agents, which would be the governments and the spending powers, as doing the same things. But let me focus on the United States. So when I look at the policy interventions that happened at the beginning of the pandemic, I think history will remember us well, all of us, the central banks and the fiscal agents, because there was a commitment to recognize that we were here for no fault of our own. This is just a pandemic and it's nobody's fault, but it was doing devastating damage to a part of our economy, to the whole economy, but especially hard on people who relied on in-person contact for their livelihoods. And so we really did in the United States have a tale of two pandemics. And when I look back at the policy interventions the central bank took, that would be us, we lowered the interest rate. We opened many, many facilities to ensure that liquidity was provided, facilitating what the Treasury Secretary at the time and in Congress was doing to offer aid to both small businesses, medium-sized businesses, but also to everyday Americans through our unemployment insurance and fiscal, they called it stimulus, but I would really call it fiscal support. So that part of this, I think, we fared very well because of the interventions were so strong and so timely. Now, then the question is, well, what about inflation? And I get asked this question a lot. And this is really a tale of, we have extraordinarily good demand in the United States, aggregate demand, and this is true worldwide. Because of the fiscal and monetary policy support, demand was able to weather it. Many, many people made it through the pandemic without destroying their entire savings and their wealth. And many people actually were able to continue to save during the pandemic because we had limited things to do. So with that in mind, supply has not kept up. And so we have too little supply and too much demand. And now it's about bringing it back into balance. And that's the job ultimately of both the people who work on supply chains in COVID and trying to get those repaired and COVID behind us, but it's also critically the job of the Federal Reserve. The Federal Reserve, one of our core responsibilities is price stability. Our other one is full employment. We have a good labor market right now with a lot of strength in it, a lot of momentum, but we have inflation that's too high. And I think at this point, every American feels it. I always say, or I hear, people have three things on their mind right now: inflation, inflation, and inflation. And so this is really about us getting that right and bringing ourselves to a smooth landing, which brings all the people through the pandemic, but also delivers that price stability that everyone wants. We ultimately want people not to think about inflation when they get up in the morning.
Yeah, so just to follow up on that, then the fact that you mentioned a lot about supply disruptions and the fact that aggregate demand perhaps is falling way ahead of it, do you think that the Federal Reserve's current aggressive policies of raising interest rates is going to be enough in taming inflation?
I do think it's going to be enough. One of the things that we know is that we're a data dependent Fed. And I actually wouldn't characterize our policies as aggressive or behind. We always get characterized one of two ways: either that we're too aggressive, we're getting ahead, or that we're falling behind. But I actually look at our policies and say that we have two mandates. And let's think through the lens of a low to moderate income person, a lower to moderate income family or a community. Those are the people, the very people which the pandemic hurt the most. And so part of our mandate is full employment for those individuals, making sure that they can fully recover and get back in and have a sustainable growth. Of course, the other part of our mandate, price stability, actually falls on them the harshest when prices rise, because it's a regressive tax. A larger fraction of total income, disposable income, is spent on the very things with prices rising than for a wealthier family in a higher income area. So when I think of those two things, I think of this balancing act of getting policy as just right as we can so that we continue to support the labor market, but we bridle back this inflation. So as you probably know, or if not, I'll share with you, right now we're all positioned to, unless there's something unforeseeable that's before us, all positioned to raise interest rates off the zero lower bound in March, and then continue to create subsequent increases so that we can get the policy rate in the United States much more in line with the economy that we have. And those are the things that I see as appropriate given where we are in the recovery from the pandemic.
Yeah, thank you so much. I think that we've all learned a lot about inflation and the pandemic from these few questions and answers that we've been engaging in. I think just to move a bit to perhaps a more macro perspective, in terms of the Federal Reserve, how difficult it is to strike a balance between short and long-term goals, and are there any economic indicators that are especially important to you personally when making decisions regarding monetary policy?
Yeah, absolutely. And the way I frame it in simple language to myself, I have it written on my whiteboard in my office, is that we work with the economy we have and we work toward the economy we want. And that is my job. It's supposed to be focused on the short term and also the medium and longer run. When I think about putting some specifics around that, let's think of the labor market first, and then I'll talk about inflation or price stability. In the labor market right now, the US economy, the labor market is on every single measure except for two, basically fully recovered. And in fact, having some historical peaks in quit rates. We have a low unemployment rate. We have good job growth. We have high quit rates, and people only quit when they're confident, right, that they can go back and get other jobs or find a different job. We really have wage growth. We have employers complaining every day that they can't find workers, not even with qualifications, just workers, people to staff restaurants and other things. Even if they've never worked at a restaurant, they still can't find them. They'd be willing to hire them, they tell us. So these are really great things about the labor market, and that's the economy we have today. And it's one of the reasons that we want to raise the interest rate, because we have inflation that's bearing down on us, and we want to make sure the economy doesn't get growing too quickly, unsustainably, and then have to endure something more painful as a correction. So that's the economy we have today. But in my mind, every moment is that the economy tomorrow could look different, and we hope it will look different, because there are almost 4 million people who were working before the pandemic started who are not working today. And those are 4 million people who used to work and used to like to do that, had a living, got income, but they are sidelined right now, either because COVID-related disruptions in schools and things still require childcare, or elder facilities still require them to help out with their parents, or their health isn't particularly safe in their minds, and they want to make sure they're taking precautions. So those are the things that I'm working towards, and it all comes back to the same thing, which is create a sustainable economy, because what we've learned over periods, decades of research is that a durable expansion is the very best thing for an inclusive and broad-based full employment goal. That really matters. Now, let me say one more thing then about that economy today, economy tomorrow, and this will, I think, resonate with all of you in London and in England, and if any of the ECB colleagues are listening, that basically we are fighting big structural forces down the road that have pulled inflation down for over a decade. Many countries couldn't get inflation up to their mandated target during the last expansion after the financial crisis. And those same forces, which are the aging of the population, slower productivity growth, they're going to be with us after the pandemic is gone. But right now we have high inflation, so we have to bridle it back. So right now we're fighting inflation from above our target, so we have to pull it back. But we will, after the pandemic recedes, most likely be buffeted by the same forces that were there before the pandemic, which is all this pressure on inflation on the downward side, and causing many central banks to recognize that we might be fighting inflation from below our target again. And balancing those two things is important as we get to the smooth landing I described earlier.
Thank you so much for that. Just to shift away perhaps from inflation and talking about the US, following the news earlier today where the Russian central bank did raise their interest rate up to 20% in response to bank runs and the ruble crashing, economically, what do you see in Russia's future?
Well, it's really not, it's too early to know how this will play out. I mean, the first priority, of course, is to try to end the conflict. And I'm hopeful that all those individuals working on it are doing just that. The economic fallout will have two parts, really. One is the immediate part, which you've just referenced, but the other is the longer term part. And we know from history that the shorter the conflicts are, then the lesser the long run impact on the economies of Russia or other neighboring trading partners, et cetera. So right now, it's my mind is all focused on what is this going to do to the short run or even medium run outlook for inflation and global economies. One of the true things is that it creates a tremendous amount of uncertainty globally, and uncertainty is almost always a confidence depressor. Uncertainty creates caution, uncertainty creates a decline in sentiment typically, and uncertainty means that we will have a negative demand shock in all likelihood. How big that negative demand shock is hard to say. But I always think at this moment, it's really important to end by saying this, that the top of mind concern is really for the Ukrainian people and everyone involved in the conflict. And that's where my mind always starts is with those people who are enduring this. And I have many employees here who actually have family or friends in the Ukraine and in Russia and in nearby areas. And so my mind is there today with them.
Yes, I can imagine that the conflict definitely weighs heavily on a lot of our minds, and it definitely creates a lot of political and economic uncertainty amongst all of us globally, especially in Ukraine. Given that this week is also Women's Rights Week, and it's a campaign that LSE is also promoting, as a woman and a member of the LGBTQIA plus community, do you think that there's enough diversity and inclusion in the Federal Reserve? And if not, what can be done about it, and what policies are you perhaps pushing forward?
Absolutely. That's a great question. So I'm going to begin by saying what I deeply believe is true, that this idea that do we have enough, that we need to kind of rethink how we think about this. And it's not a destination to be inclusive and diverse. It's a journey. It's a continuous journey, because we might find ourselves feeling very satisfied, but then recognize that new diversity appears every day. New abilities to be inclusive appear every day. So I have this really journey mindset that we're always on this journey. That said, there are historical gaps that have accumulated over decades, even centuries, that leave us woefully behind in our ability to represent the communities we serve, not only in the central bank in the United States, but across the globe, really. Many fewer women than the population, many fewer people of color in the United States than the population. And those are real challenges that we need to continue to make progress on. And we're devoted to this, we're dedicated to this. The reason that I'll start with, and then I'll tell you some practices and things we're working on specifically, but it is not just about fairness. This is about making good policy. It's about doing our very best for the people we serve, because if you don't have the lens of all the people in the population, then you actually can't spot the problems that everyone is facing, and you certainly can't spot the solutions. So diversity and inclusion is really the best way to do optimal public policy. So with that in mind, what we've done in San Francisco, but many other banks in the system have their own initiatives, and the system more generally in the Federal Reserve is working on these issues. But here's what we're doing in San Francisco. We launched something we call the Framework for Change. And we did that in January of 2021. And that framework had multiple components, but it really was a deep recognition that simply aspiring to be better at inclusion and representation wasn't really going to get us there. I mean, you could inspire all your life, but we wanted deliverable goals. So I set out and I said to the team, if we were entrepreneurs and we had a 5-year plan, what would we be doing? And the team came up with these ideas that first you would hold yourself accountable to real goals, real metrics. And then you would go out day by day, figuring out what processes, what policies are in the institution that just keep the inertial way that we've been doing things continually going. So we've done things like one of them is with diverse suppliers. So central banks buy a lot of stuff, so do universities. And some of the things we buy, there's only a couple of vendors, like our machines that process cash. And so that's just, we've got to take that. But we do a lot of things, everything from buying, t-shirts for our teams, to where do we get our pens and paper, to where do we get our backpacks. Those can all be done with diverse suppliers. And we've really made a commitment to our communities to buy local, buy small, and buy minority owned. And that's been a huge improvement in how we do vendor management. That was just a process change. Another process change we've done is to post every job. every single job. We're no more tapping on the shoulder. We're going to post, we're going to make sure that we have diverse candidate pools, and we're going to make sure that if we're not getting a diverse candidate pool, we don't hire, we go back in. And those commitments are important. And then the final one I'll mention, although I can give you a list of others, is that we're committed to having a diverse board of directors. We have all of these private sector citizens who assist us in our work, in our boards. It's very atypical for other central banks, but that's how the Federal Reserve System is set up. And they have to also be diverse and represent the communities we serve, because if we don't do that, we're not accountable. So I think in about a couple of weeks, we're going to be releasing our report card for how we did last year. And that report card is also very important because we set lofty goals. And we don't make all of them the first year, but that's okay. I would rather fall short of a lofty goal to make progress than meet an easy one and have nothing to look forward to.
Yes, thank you so much. I think it's very reassuring to hear that there are so many attempts being made in order to ensure that a diverse background is being represented within a central bank, within a public sector organization. And on that note, where do you see the future of the central banking system? Is it possible to keep it independent, or is there a risk of government policies coming into conflict?
I really do think that there's a broad understanding that an independent central bank, and this is not limited to the United States, there have been decades and decades upon decades of a recognition and proof that when central banks are independent, then the countries that they're independent in fare better. The economy fares better because ultimately the Federal Reserve, but this is true of many other central banks, even though they have different mandates, we have lending powers, not spending powers. And the fiscal agents need to spend. Those are the decisions as elected officials they make. They can build and invest in ways that we cannot as the central bank. But when we're outside of those decisions, then we can accept the economy that we have and manage it so that it hits our objectives, which are price stability and full employment, but also creates this sustainable and stable path of growth. And that has been something that's proven very beneficial to us. And the dangers of not having an independent central bank are well known. So I don't think there'll be a lot of momentum to take our independence away, because ultimately it's about checks and balances, and it's about everybody working on behalf of the American people in the United States, but everybody working on the things that they're assigned to that they do best. And so that for our role, that's a narrow lane, but it's an important lane and one we take seriously.
Yes, okay. I definitely think that that's something that all of us will take into consideration. I think that you have, just circling back to perhaps a bit more personal questions. You have mentioned consistently that you consider Janet Yellen as your mentor. What are the key lessons you felt that you have perhaps learned from her, and how important do you think mentorship is in the financial public sector?
Well, I will say that my belief is, as a person who's lived much longer than you all, that you can't do it alone. You need people to help you and guide you. And I think as individuals, as humans, we don't ask enough for help. We're afraid that maybe the person won't want to, maybe they will be bothered by us. But I've learned from Janet that that's not true. That even though I might have been afraid to go up to her when I first met her, she was not afraid to offer her thoughts and views and help me. And so I think that's one of the key lessons I'll give to each of you is just ask for help. People who are, Janet's age, my age, even younger than us, we like to help because we see our future in all of you. And mentoring is one of the biggest ways we can give back, but it's also one of the biggest ways we can shape the future. So that's my big lesson for all of you. But let me talk about things that she's taught me about central banking and about, I'd say, just being a human. So I am a very other focused person. It's why I do this work. I really want to help people, but I learned in economics things with models and math, and I wasn't sure how to blend those two things. I got into economics because my view is economics is about people, and I wanted to assist in understanding people and how they interact with each other, but also contribute to making the economy better and one that would work for everyone. But that was hard. right? Especially when you're in classes, you're trying to think about finance and economics and models and math. And Janet basically said that both were important. I've seen Janet in so many different places where she could be giving a monetary policy speech that can go toe to toe with any of the most technical academic speeches, as you would imagine, that you've ever heard. And yet she can turn around, walk off the podium, and someone will come up and say, you know, Dr. Yellen, President Yellen, Vice Chair Yellen, Chair Yellen, Treasury Secretary Yellen, it's such a pleasure to meet you. And time after time, she stops, she grabs their hand, and she smiles at them. And that is what being a human is all about. That's what being a good economist is all about. And it's certainly what being a good public policymaker is all about, is you have to remember why you're doing it. And Janet not only showed me that that was possible, but lives that every day. And so I just try to model myself after that. And it pays huge dividends. I'll conclude with this about Janet is you can tell from how I talk about her that I think she's one of my most admired people I've ever known, and one of the most admired people I've ever read about. So I loved reading biographies as a kid. And one of my favorite figures was Eleanor Roosevelt. And I wondered what it would ever be like to meet someone in person who was like that. And then I met Janet, and that's what it's like. So find someone in your own lives who you admire greatly and you want to know, and then don't be afraid to know them. It might not be that you'll have a relationship like I have with Janet with everyone, but you'll have a relationship, and that's what's important.
Thank you so much for that insight. I think you might have touched on this a bit, but I would still like to ask you, just to conclude this moderated Q&A session, what is one piece of advice that you would give for a student who wishes to start a career in central banking? And looking back on your career yourself, is there anything you wish you did differently or something you wish you knew?
I wish I had been braver earlier. I think I sat a little bit back thinking that maybe the way I thought about the world, maybe the full Mary Daly wasn't going to be wanted. I wouldn't belong. And I wish I had found my bravery earlier, because the world only changes when we bring everything we have to our jobs and to our work. So as you're going out and thinking about contributing, don't look at what you should be, look at what you could be, and bring all of yourself to work.
Yeah, okay. Thank you so much for your answers. It's been a pleasure talking to you so far. We're going to conclude the moderated Q&A session now. So right now, I do have a few questions that the audience has sent in throughout our conversation. So I'll dive into them as well now. So firstly, Asher asks, outside of looking at p-values, distributions, and statistics, how do you form a good gut sense for the macroeconomy?
That's a great question. So the way I do this is you first have to recognize that data dependence doesn't mean just measured data from publicly provided sources or statistics. It also means talking to people. So you have to get with your contacts. I have many contacts. I spend as much time talking to CEOs, small business leaders, community groups. We have councils for Economic Advisory Council, Small Banking Advisory Council. We have a Community Advisory Council. I have CEO roundtables all the time, where CEO is a big definition. I just met recently with Native Americans and around tribal leaders. Then you meet with community groups, or you meet with people who need or offer small dollar lending, because ultimately you've got to fill out what the data doesn't tell you. There's this big part of analysis and forecasting that's the richness of the in-between. Right? You have these in between the things you can measure, and that's where all the richness of what is going forward looks like. So you have to be fiercely curious, just want to know, and you can't be satisfied by p-values or statistics or anything that looks like truth, because the truth is an evolving thing. So I have this mantra that I use for myself: be curious, be confident that you've done the best you can with your curiosity, but then right after you've called a decision or you think you know, be humble enough to go back and start again.
Thank you so much for that. Um, Just like another completely different question, the Federal Reserve is currently in the process of developing its central bank digital currency. Do you think that the pros of having a digital dollar, perhaps in terms of efficiency and secure payments, outweighs the cons of it? For example, less privacy for the users. And do you foresee any potential problems or risks that might arise from this?
Great question. So first, we're not in the process of developing a central bank digital currency. We're in the process of studying whether such a development would be the right way to go. And a couple of weeks ago, it could be more, I've lost all track of time in the pandemic. I will apologize for that. But quite recently, the Board of Governors released a white paper on central bank digital currency and laid out the two things you just noted. There are benefits to having said currency, but there are also risks or consequences or costs, and sorting those out very effectively will be the decision making. Does the value proposition of having one, offset the cost of developing one? And what I can say myself is when I look out into the world, and without a crystal ball, but you just look out, technology is changing. And there are many benefits to having digital transactions, digital processing. You can list them all, but there are also many ways to get to that path. So I see the next several years as being one of intense study that does those trade-offs you just mentioned. Where people in the United States or globally really going to be comfortable with a central ledger where there's somebody who's keeping the records of everything, and also what are the value cases for it? And there are many ways to get part of the value case without having a central bank digital currency. So all of these things are to be determined. The one thing that I will say is that trade-off you just mentioned is exactly what the white paper laid out, and exactly what all of us are thinking about. What are the costs and benefits? And then do we basically, as a nation and as a world, decide that they're worth it and we're going to go forward? And then how do we put the right parameters on it so that those costs or concerns are minimized?
Yes, I think that that's definitely a fair answer to make, and it's definitely a question for the future. Just moving on to the next question then, as Sean asks is, what exactly does it mean to sanction a central bank and its reserves?
It just means that you don't have access to those reserves. And so those are not decisions taken by the Federal Reserve. That's one thing I will say. Those are decisions taken by governments. And you think of the Federal Reserve or a central bank in most countries. Now, I can't speak for every country because I can't say that I know the specific decision rights in every country, but for many central banks, they're intermediaries, financial intermediaries that help the financial system work rather than being decision makers. And those decisions are made by the sovereigns, by the fiscal agents and the sovereign governments. And so the Treasury Secretary and the administration makes those decisions in the United States, and then the Federal Reserve carries them out.
Thank you so much for that. In terms of just moving on to the themes of decision making then, another question that we had was, how does the Federal Reserve decide which countries it should engage in liquidity swap lines with?
Well, these are very good questions. The New York Markets Desk will have an entire portfolio of descriptions of how we make those decisions. But the thing that we do is we're often a reserve currency in the world. Our financial markets are safe havens, and so we recognize that we have a responsibility to ensure that when there are liquidity crunches, that we are allowing people to trade their treasury securities for liquidity, because those are otherwise we are depending on the people buying these things, but we're then not engaging in liquidity transformation when countries need it in times of crisis. And so that's the commitment. And then thinking about which countries we participate with, that there are a lot of rules and regulations about this to ensure that we're not, there's always trade-offs in any of these things, that you're not facilitating activities that you can't support as a nation while you're supporting the financial intermediation across countries, especially during times of crisis. So I'll direct you for more specific details of that to the New York Fed Markets Desk, but those are the broad parameters of how we decide.
Okay, thank you for that. That definitely was very insightful. Another question that we had was, what was the mistaken assumption which led to the Fed believing that the inflation was transitory?
That's very interesting. I wouldn't quite phrase the question that way, but I will take it all the same. So there was quite a bit of recognition across the globe, not just at the Fed, that the inflation pressures we were seeing early on, and this is true especially of the United States, were related directly to COVID. So then you ask, what is the mistaken assumption that we made that made us believe that they would wane? And for us here in the United States, it was really that COVID would persist. We thought with the vaccination coming so early in the evolution of COVID that we would get a lot more take up and we would be able to beat back the virus much more quickly than we did. And I also thought myself, I'll speak for myself, that because of vaccinations ability to really curb the disease propagation, that we would create a much more global system for distributing those vaccinations, and that the global system would pick up those vaccinations. But as you know, today, that's just not happened. And so we're now 2 years into the pandemic and finally just coming out and saying that we think we're moving from pandemic to endemic. So if I go back to all my forecasts, the missing link, the missed assumption or the wrong assumption in retrospect was I just thought we would do better at beating back the virus. And so we didn't beat back the virus as quickly as I had thought and certainly hoped. And as a consequence, the inflation persisted for longer, even though it's still related to, by and large, COVID-related disruptions. So ultimately, then we got an economy that's in the United States achieved a very strong labor market. We have a low unemployment rate. We have a good labor market, and we have inflation that's too high. And so it's time to adjust our policy instrument, the funds rate, and our balance sheet policies to get the policy support in line with the economy we have. But the reassuring thing I hope everyone takes from this, and certainly this is one of the things I speak a lot about in the United States, is that we have the tools to bring inflation down. We have a long history of being extremely effective at that. And we are adjusting policy to continue that history.
Yeah, definitely. I think that it would be an unfair burden to ask governments around the world to try and predict how and when the pandemic is going to end. And definitely, as you mentioned, that it's all about using the right tools to react to them. Another
May I
question that we,
add, Jane,
sorry.
can I add one thing to that? Because I think it might be useful. I didn't mean to interrupt you, but you know, one thing I always try to ask people to think about is the bridge, when people say, did we build a bridge that was too long? Did we offer too much policy support, either monetary or fiscal? And we'll let historians decide that. But when you're faced with two choices, a bridge that's too long or a bridge that's too short, I want to be on the side of history that builds it too long, because that's how you get as many people through it completely. And you look back and you say, might have been a little too long, but nobody fell through.
Definitely. I think that prioritizing inclusion and making sure that more people or everybody who needs it actually gets the policy decisions that are right for them is definitely something important. Um, Another question that we have from Asher is more on the management side. How does your branch of the reserve react to decisions from other branches, especially decisions that might go in a different direction?
What's interesting, you know, that I've worked at the Federal Reserve since 1996, which I know is a long time and longer than many of you have lived. But that all that is being said, one of the things I've noticed is that Federal Reserve system banks all are actually working towards the same goal. And that goal is to ensure that we achieve our policy mandated goals for the American people. And so there's not as much difference as you might think. We all do have different geographies. And so Federal Reserve Bank of Dallas might have different policies in place from Federal Reserve Bank of San Francisco. That really reflects the communities they serve. But those policy differences are actually fairly small relative to the amount of similarities. So my reaction is, if someone takes a different decision than I would take, I just want to know why. And what can I learn from it? And sometimes I'll think that our decision was better, preferred for our group. And sometimes I'll say, oh, that influenced my thinking. I'm really going to learn from that. I would say that these lanyards are something I learned from the New York Fed. So the New York Fed, I saw my friend John Williams, who's the president of the New York Fed, and he had a lime green armband on, which I'd never seen him wear before. And I said, well, John, what's that? it looked like one of the people wear for a running event or something. And he said, well, this tells people that I really am okay, comfortable being near others. And so when I heard that, I was like, we've got to get something. So we have wristbands, and we also have lanyards that we're not lime green because we like to have a little uniqueness. So we're blue if you like to be near people, and you're orange if you would prefer to have a little more distance. And so that's a small example, but I guess the main answer I have for people is there's a lot more similarity than difference because we're all swimming towards the same goals. And we actually have a really collegial relationship. All my colleagues, I learn from them as much as anything. And I think all of us could say that.
Thank you so much for that. And I definitely think that there's definitely a lot of lessons that we can learn from each other. Another question that we have that is pretty interesting is that, do you think that modern monetary theory or other perhaps unconventional monetary policies will be more common post-pandemic, particularly in emerging economies?
I don't know. That's my truthful answer. But what I do recognize is that, you always have what we call unconventional. And then you give it a good listen and learn, and then you decide, is this going to be something that not just solves a problem for the short term, but actually has sustainability to it? And so without getting into the details of modern monetary theory or other unconventional approaches, what I will say is we always come back to the same key principles. Nations should be able to pay for their commitments. You can't run an unsubstantiated commitment forever, because ultimately that will fold on itself. And the nations that do pay for their commitments, their spending commitments, their global commitments, they fare better in the long run of history than nations who don't. And I think emerging nations know this, and industrialized nations have learned this, sometimes painfully, that that's the way to the future. It's just like households. It's also hard to ask households to budget themselves and then turn around and not have governments do the same. So with that in mind, I look at these I am very curious. I studied Marxist economics as a student, and everything that you could possibly study, I study. But I take from it always the same thing, that we want to create something that's sustainable, productive, and inclusive.
Yeah, thank you so much for that. And just to perhaps look into a bit further in terms of the future and what holds in terms of currency, uh, an audience member asked, what is your stance on the effect of Bitcoin, stablecoins, NFTs on the economy, and the central bank's control on currency?
Sure. So this is I really love getting this question because I get to start with something that very few, including many of people who are working on this, really distinguish, even though they know it's different, is that Bitcoin, stablecoin, and digital currency are completely different elements. They're completely different. So let's start with Bitcoin. Bitcoin is not a currency. It is used as a medium of exchange in some situations, but it's really like owning any kind of asset from the stock market. It's a fixed quantity that they base on how much they have mined, and then it fluctuates in value depending on how many want it. And so it's not a stable form of exchange because it fluctuates as conditions fluctuate, even if those aren't economic conditions. So stable coins are a new development that looks very much like a money market fund, in that it says that you put here and dollar for dollar exchange on demand. But there's a lot of interest in whether those are not actually the reserves that those companies hold don't have dollar for dollar exchanges available, so that if there was a run on a stable coin, that you would not have the stability that you would want. And there's been much work in the SEC and other organizations, not the Federal Reserve, about those types of things. So when I think about financial stability, which is one of the roles the Fed has in thinking about financial stability of the economy, along with other regulators, I really think about those. Where are we vulnerable to runs, which we would then have to intervene in because we're the lender of last resort for the United States. And so where are the risks lie? And what I learned from the financial crisis is that the known risks are the ones that you're familiar with, the ones you have regulations, the one you have protections against, but it's the unknown risk that really can bubble up and cause problems that you're not even aware of. So a lot of our attention, my attention, is in thinking about, in particular, stable coins and whether they pose any financial stability issues. Right now, they're very small as a proportion of all payments, of course, and transactions, but they are getting bigger, and so it's top of mind. And this is very different than a digital currency, which I'll conclude with. A digital currency would be having a dollar-like asset that's digitally exchanged, and that would have the same properties of currency, where you can use it as a medium of exchange, but it grows as the economy grows. And so it doesn't fluctuate in value depending on, at least within the nation, depending on the situation you find yourselves in. You know, you can take $1 into a store and it's $1. You don't get 50 cents on the dollar. And so that's where currency is very, very, very different than these asset classes.
Definitely. I think that there's a lot of complications and a lot of different aspects of new technologies and new asset classes that we definitely need to consider in terms of adoption. A question from Sarah in terms of your specific focus or specialization in the labor market. She asks what your take is on the impact of recent inflation on labor supply and labor demand on industrial employment specifically in mining and manufacturing sectors, and how does monetary policy play a role in this context?
Sure. So let me unpack that a little bit and say that, so in terms of labor supply, well, labor demand is very high. And that's, you could be in any sector and you have multiple jobs at your disposal right now because these markets are booming. And the same thing is true in manufacturing and industrial sector, that the market is booming and they're looking for workers. In fact, when I'm out talking to my contacts, that's the daily complaint, that they just can't find enough workers, or they could be growing more quickly. So that's true. Inflation and labor supply, I mean, the mechanism, the channel that would work through would be that workers decide that they need to work more, provide more labor because they feel like they're losing ground because of inflation. But right now we haven't seen a lot of that effect. And I think it's partly because people have real constraints that, you know, they're still trying to manage that, as I mentioned, the childcare constraints or elder care, or just being worried about their health. But I'm hopeful that as those constraints ease, that more people will come back in with labor supply. And when I think about all of this together, the Federal Reserve doesn't actually target a specific industry or a specific sector. We look at the composite economy and we try to balance demand and supply. And we find ourselves right now in a situation we have more demand than we have supply. And for us, we have to bridle back demand until supply can recover. And I'm hopeful that in the coming year, 3 things are going to happen in the United States that's going to ease up some of the pressure. One is we're going to adjust policy. That's our role. 2, the fiscal support that so many Americans were getting will roll off, phase out, and that will make demand much more in balance with the economy and not outsized relative to how well the economy is doing. And then the third thing is that supply constraints should start to ease up as we get through the pandemic. But we've been saying that for a while, and what we keep running into is that we're living in a global economy, and while we might be in a better position today, or you might be in a better position in Britain, you know, the rest of the world's still struggling, especially in Asia. There's some intense struggles with the virus, and so those are going to affect global supply chains. So I'll be watching all of those factors carefully, and then putting those together to see how much the Federal Reserve, needs to adjust the policy rate. But the goal is to get demand and supply more in balance so that we can have something more sustainable than what we see today.
Yeah, thank you so much for that. You touched a bit on global recovery and how important it is to align all of the recovery in, you know, in a lot of the countries geographically, so we're able to move forward together. Hakeem asks, how do central banks in advanced economies differ from central banks from emerging economies when it comes to perhaps balancing economic development and financial stability?
Sure. Well, you know that, and this is well known. It's there's a privileged position to be one of the bigger, more established nations because not you're not as vulnerable to shocks in a country that's not yours. But if you're an emerging nation, you're much more vulnerable to shocks or to changes in policy that you're not making. And so emerging nations find themselves, and I hear this a lot from emerging nation partners that we talk to, is that, they're just the takers of whatever we do. But central banks think of their own domestic economies when they make policy. That's the charge of almost every central bank I know, is to make the policy that's best for the domestic economy. So in emerging nations, I think central banking is harder because I think that you're making decisions that you have a whole part of the things you have to think about are not things going on just in your nation, but things going on more globally. But increasingly, and I'll end the answer here, increasingly in the time I've worked at the Fed, the United States is more buffeted by things outside. I mean, think of the pandemic. One of the reasons we have such severe supply shocks and such severe supply constraints is because we live in a global economy. We don't produce everything in our own country. And so we're much more integrated. And I think that's actually a good thing for the globe, but it is a hard thing for countries to get used to. And it reminds us all that we ultimately are all interconnected, even if we live in different nation states.
And yeah, just to follow up on that, Ishan asks, when the Federal Reserve raises interest rates, like you mentioned, it does impact low-income developing nations. To what extent does the Fed factor in these spillover effects then?
So that's a great question. It allows me to put a finer point on what I just said, which is our charge, which we've been given by Congress, is to make policy that's for the US economy, to ensure we've got a sustainable growth and price stability and full employment. So when we're thinking about our policy choices, we're thinking in that frame. Of course, we recognize the impact it has on other nations. And in many cases, the way we think about that is to understand that that's, what we do affects other nations who could affect global growth and sometimes negatively. And so we would factor that in. So it's true of all central banks, is that we make policy independently of each other, and we find ourselves actually spilling over onto each other. And the best way to think about this is to just recognize that we're a global economy, and I can't change my decision because I'm required to think about the US. That's the job, but I can understand the impact of my decision on other countries and then think about ways to use our voice and our understanding of the economy to alert others of that potential impact.
Yes, thank you so much. And just to continue on the theme of the US and other economies interacting, the last question that we have for you today is, what are the measures that the Federal Reserve is taking to maintain the role of the US dollar as the world reserve currency against potential rival currencies such as the renminbi or the euro?
So we do nothing on that front. The role of the Federal Reserve is to be the financial intermediary and to be a lender of last resort and to do American monetary policy. So we do nothing to try to keep that reserve currency role. That actually, when you study it, is really related to privacy, private property rights, whether people think that their assets could be seized and not let out of a country. That's really what allows the countries to have a reserve currency. And so in the United States, it's really about what the fiscal agents are doing that matters the most, because it's about the property rights. If you put your money in a US bank, you can get it out. And that is what people depend on. If you invest in treasuries and you want to get liquidity provision, then we have those swap lines that allow countries to do that under certain parameters. So those are the kinds of things that assist. But I would see, the real characterization I would have is that this is about the sovereign's decision making about how they run the business and what people have rights and access to, much less than about the Federal Reserve or any central bank.
Thank you so much, President Daly, for answering all of our questions today. Unfortunately, this is all the time that we have for you today. Um, On behalf of the Central Banking Society, I think that it's a pleasure for us to have you here and for our audience members to have their questions answers. We definitely covered a range of topics, and I'm sure that all of us have learned something insightful from you, and we really appreciate having you here with us today. And so, yeah, thank you so much for this.
It was my complete pleasure. I hope you all are well and everyone out there becomes an economist. We definitely need each and every one of you.
Yes, thank you so much for today's session.
Thank you. Bye-bye.